Let's bring in Tom Essaye now. He's the founder and president of Sevens Report Research to talk about the markets and how he believes investors should be positioned. Tom, thanks a lot for joining us. The market is still digesting the comments from Jerome Powell at Jackson Hole on Friday. What's your take on the signal he wanted to send to markets?
Good morning, everyone. Thank you for having me on. I think that the signal he wanted to send was that the Fed is not about to get any less hawkish. And he sent that signal loudly and clearly, as we saw in markets on Friday. And I think that's something that investors are going to have to digest here. And it's not going to be a one-day process. It's going to be a multi-week process where we realize the Fed and virtually every major global central bank, they are serious about getting inflation lower, and that means higher rates.
Is inflation in the U.S. beginning to track lower? Do you believe that we have seen the peak in U.S. inflation?
I do, but the peak, investors shouldn't focus on the peak, right? The peak has to come, but we're still so far over where the Fed's target is. It's historic, right? We're at 8% CPI. We need to be at 2%. So the question is, how quickly does inflation recede? If it recedes quickly, that's good for stocks. If it does not, that is bad.
And recession risk. One major risk, of course, when a central bank applies the brakes is that it may slow an economy down into recession territory.
I think that everybody should be prepared for a material economic slowdown. We can, people can throw different definitions on recession, but at the end of the day, the economies will slow. People should be prepared for that. Unemployment will rise. Okay,
so how do you think investors should be positioned? Do you think they should have a defensive posture at this juncture?
Yes, I do. We have to take in context that stocks are down a lot already year to date. So some of this has already been priced into markets. And there is a possibility the Fed sticks this soft landing. So I think you do stay invested in the market, but be defensive. Be in those defensive sectors, utilities, staples, healthcare. Lower the beta so that you're not going to get shaken out by the volatility that's coming.
Why don't we take those segment by segment? Utilities. Why utilities?
They're a high yield. Obviously, their business is inelastic, right? Everybody needs their power. And then also we're seeing a revival in nuclear. We're moving back towards a bit on the fossil fuel type of the spectrum. And I think that's positive for utilities going forward.
Staples, consumer staples, do you have a sharply different view of consumer staples versus the consumer discretionaries as inflation surges and makes it more difficult for consumers to purchase some of the things they would like to have but perhaps don't need to have?
Absolutely. So consumer staples over the past year, the story has been increased inflation will sort of squeeze them because they can only raise prices so much. Well, guess what? As inflation begins to recede, that will help consumer staple margins. I like that much over consumer discretionary. We know the unemployment rate will rise. That will constrict consumer spending.
And the healthcare sector, a big sector in the U.S. It's very germane to Canadian investors as well because we don't have a large publicly traded healthcare sector in this country. So when Canadian investors want exposure to healthcare, they often go south of the border to get it. It's a diverse sector. What are your thoughts on healthcare and which segments within healthcare you like the best?
I think that healthcare broadly, obviously, is very economically inelastic, meaning that demand is consistent regardless of what's happening in the economy. I think that some of the insurers are very attractive. Insurance costs are way up here in the U.S., as I imagine they are in Canada as well. Also, like some of the hospital companies like an HCA are also attractive as well, especially as the world continues to get back to normal. We see more elective surgeries. That should be good for their bottom line.
And the REITs. Now, in Canada, we do have a large REIT sector, real estate investment trust. There are differences between a U.S. traded REIT and a Canadian REIT, but why do you like the U.S. REITs at this juncture? And same question, it's a diverse sector. There is different types of real estate owned by the real estate investment trust. What type of real estate do you like the best?
So stay away from single-family REITs for obvious reasons, right? Mortgage rates are way up. We are going to see some weakness in prices in homes. So I think that some of the single-family REITs you stay away from. The commercial REITs, especially those on the infrastructure side of things, like an American Tower or something like that, those are very attractive on a yield basis, right? And again, they're defensive. Their demand is inelastic, even if we see a material slowing in the economy, which I think we do see over the coming 6 to 12 months.
Some very prominent sectors that we have not mentioned. What about the financials? What are your thoughts on the big U.S. banks and the bank stocks?
I don't see where the growth is going to come from, frankly. I think that the yield curve could steepen a bit, but not materially. And I don't think you're going to see a large increase in consumer demand for loans, not with yields, not with interest rates where they are. So while I don't think the sector is at risk, I don't see where the growth catalyst is for them right now either.
And the tech stocks, the stocks that really led the declines starting in November when it became clear to the markets that interest rates were going up.
So I think that tech, I think that you should still stay away from those. And those, of course, are some of the companies that have fallen the hardest. Then if you look at really the super cap techs, your Apples, your Microsofts, your Oracles, your Ciscos, old tech, if you will, I think those are attractive because they take on defensive properties. They have massive free cash flow. They have very insulated customer bases, and there's very strong demand. So I think they are attractive, but you definitely want to go higher quality in tech.